investment strategist at CFC Seymour. He joins us now from Hong Kong. Derek, great to see you this morning. I have to start by asking you, were you caught by surprise by the Fed's move? And, you know, what's the thinking behind all this?
Yes, I was surprised that they moved before the next week's meeting, because it seems that there was only 8 days left, and I was also surprised by the magnitude of the move. However, the market was not that surprised, because there was a lot of speculation that they would do an intra-meeting cut. Clearly, they were scared about what's happening with the financial markets. Not only the wealth effect turned really negative, which increases chances of a recession because people's investments are worth less, but also the tightening credit conditions in the financial markets mean that there is less cash available for lending to consumers and to businesses. So growth outlook deteriorates on that front as well. They must have been really spooked by that, and we had this dramatic reduction. Okay.
I mean, Derek, if you look at the Asian markets, you know, it's having the right effect, that surprise move, not so much of an effect in the U.S. markets by the end of the day yesterday. The question here is, you know, is this the right medicine in the first place? Is it enough? You know, I mean, right now the whole problems, as I understand it, is caused by that housing market, which has been, you know, really hit pretty hard, and that's impacting into the wider economy. So is a rate cut sufficient to fix the problem?
Definitely not. A rate cut can only help partially to mitigate the negative impact of the residential construction recession and slowdown in consumer spending on the wider economy. So if we are in recession, which I think is a 50-50 call, then the recession will be milder because of this dramatic cut. But they cannot avert you know, a recession if one is coming. And even with the fiscal stimulus, these measures can only smooth the path ahead.
Right, soften the blow then, Derek, is what you're saying. But, you know, okay, so looking ahead then, we have the Fed meeting coming up. We have that economic stimulus package. Right now, which is looking more important to you? I mean, is it going to be both, or is one going to be more important than the other in terms of smoothing, you know, if you like, that downward curve?
I think that in the short term, it's more important that a fiscal package that puts cash in consumers' pockets is more important, because if it's going to be worth $150 billion, then we would have an, you know, potentially an increase of 1 percentage point of GDP, and this is crucial. Now, the Fed will cut rates anyway for the next several meetings. These reductions will have a delayed impact on lending, so not an immediate effect on the economy, but the major impact will be on what's happening with the equity markets. And if Fed manages to limit the bear market, then definitely this will be positive for consumer spending.
All right, Derek, let's take this to what's happening with the Asian markets right now. We're looking at signs of a mild bounce back today. You know, nowhere close to regaining the losses over the past 2 days, though. You know, how long is this going to be sustainable? You know, what sort of upside are Asian markets going to have in light of what we just talked about, you know, in terms of the package, in terms of future rate cuts from the Fed?
You know, it's really interesting to see that today's rebound in Asia does not even retrace yesterday's drop, although we had 2 days of drops in our time zone, while in the US the market was closed on Monday. So over the past 2 days, S&P 500 is down by 1%, and we are in Asia, after 2 days rebound, we are still maybe 10% down for the week. So clearly this is not enough to soothe investors' concerns. Now, in order to think about the future, you have to compare what's happening right now to other crises, such as the tech bubble, and these comparisons do not look good. I think that in the medium term, the next several months, we will unfortunately see fresh lows here in Asia and elsewhere in the world.
All right, Derek. You know, on that note of somewhat pessimistic note, we'll just
sorry about that.
We'll come back and talk a little bit more about this now. That's Dariusz Kowalczyk. He's Chief Investment Strategist at CFC Seymour. He's back in a couple of minutes. If you have questions for him as well, email us. The address is cashflow@cnbc.com. We are back in 2 minutes. To Derek Kowalczyk, he's Chief Investment Strategist at CFC Seymour. Derek, just, you know, before the break, we were talking about further downside for Asia's markets. I just want to get a sense, you know, the 2-day plunge as well, you know, in many ways putting to rest the notion of decoupling from the U.S. economy. We've seen, you know, investors really think, you know, saying that there is no such thing. There is a strong link, if you like. What I want to ask you is, what should you be doing right now in light of what's been happening in the U.S. in terms of the slowdown? Should you be putting your money in specific areas, in specific markets, or should you be sort of re-looking your portfolio and putting more money into cash or putting more money into bonds, the safer assets, if you like?
As far as portfolio allocations go, I think that we still have a lot of volatility ahead and potential downside for equity markets. Therefore, we should be underweight equities. We should be overweight cash to capitalize on further declines when we are more able to call the bottom. And I think we should be holding the bonds in our portfolio at the sort of standard allocation, because the yields of treasuries in particular have gone that low. Now, picking particular equity markets or sectors is complicated by the fact that the recent sell-off was driven by panic and not fundamentals. Valuations are very attractive across the globe and across most of the sectors. I think that we will see further downside in Asia. However, if you want to pick the indices that would be the most attractive, these would be the ones that are from countries where growth is not that dependent on what's happening in the US, but rather on domestic demand, India and China. And China is also insulated from the correlation in the capital market. So those two indices, I think, would be relatively attractive in our region. Right.
I want to pick up on the point you just made. There's a lot of talk about dependence, if you like, among Asian exporters, in particular on China, on India. Not a lot has been said about how exposed China is to the U.S. I mean, if there is a severe slowdown, what sort of an impact is that going to have, in terms of China's exports to the U.S. and in terms of China's own demand for exports from the rest of Asia?
Well, the model that we have run recently suggests that this year the U.S. will probably avoid the recession, but the first half will be almost recession, right? And given that, we assume that exports growth from China to the entire world will slow to 20% from 24%. So it doesn't seem like a big deal, especially that China is exporting to Europe and to the rest of Asia a lot. China is also benefiting from the fact that its domestic growth is driven to a large extent by fixed asset investments and consumption, which means domestic demand. So they are not that dependent on the outside world as some smaller economies, such as let's say Singapore.
Okay, I do want to ask you about the inflation picture in Asia as well. We have signs that this is on the uptick. Hong Kong just came out with some numbers for December. We have CPI from Australia as well. How does this all fit in terms of what central banks may be doing, in light of what the Fed has done?
I think that central bankers around the world are tempted to follow the Fed because clearly it opens the door for switching attention away from inflation towards growth. But the Fed is lucky in having a dual mandate, which a lot of the other central bankers do not really enjoy. They have to focus on inflation. Therefore, in relative terms, the monetary policy outside of the US will be more restrictive than that one that is run by the Fed. And for example, in Australia, we may see another rate hike actually.
Derek, does this what you said about China and India, does it apply to Hong Kong as well in terms of it being an attractive market, given that its monetary policy is pretty much tied to the U.S.?
Yes, Hong Kong is benefiting from both the tie of monetary policy and being sort of driven by Chinese growth, but I still think that Hong Kong will go down before it rebounds, because even if there's economic decoupling, in which I still believe there is no market decoupling, and Hong Kong is very correlated with what's happening across the Pacific.
All right, Derek, we'll have to leave it there. Thank you very much for your time today. That's Derek Kowalczyk, Chief Investment Strategist at CFC Seymour. And we do have